Hello and welcome. Thank you for joining us. I'm Jennifer Leonard, President and CEO of Rochester Area Community Foundation, and I know so many of you and appreciate you so much. We truly value your philanthropic support for our community and for your community foundation. What a year this has been. Thank you for supporting Greater Rochester's Community Crisis Fund, which distributed more than $6 million this year to meet urgent and changing needs. You helped your community foundation ensure that students could access their remote lessons, that arts organizations found ways to pivot and present, and that our nonprofit sector was bolstered in numerous ways. More recently, you embraced our new Racial Equity Growth and Arts Prevail funds, working to strengthen our community's equity and vitality, particularly through leaders and organizations serving communities of color who have been hardest hit this year. Our community foundation is able to respond at times like this because of philanthropic support from generations of donors like yourselves and a strong investment program that has preserved and grown donor gifts over time. The Community Foundation's long-term investment program has weathered a lot over the years, thanks to its investment discipline and sticking to its knitting in challenging times. We are so fortunate to have in our corner as our investment consultant, Michael Miller, whose popular fall talk to donors helps us make sense even in challenging times. Mike is a founder and the chief investment officer of Crucial Consulting, formerly Colonial Consulting. Mike provides the firm's clients with advice on asset allocation, manager selection, and performance evaluation. He has more than 30 years of experience in the consulting business, all with Crucial Consulting. Mike holds a bachelor's degree in computer science and a master's in statistics, both from Columbia University. He has been awarded the Chartered Financial Analyst, or CFA, designation. Crucial Consulting is a New York-based firm that focuses on providing consulting services to not-for-profit institutions such as ourselves. Founded in 1980, the firm is owned by its employees. At present, Crucial has approximately 130 client relationships, representing approximately $35 billion in capital. Mike has been our investment consultant since 2003. We are very happy to have him here this morning to present an overview of the Foundation's investment program in the time of COVID-19. A couple of housekeeping details. Mike will be able to answer questions following his presentation. You can help us get ahead of that by putting them in the Q&A section of your Zoom screen. If you have questions about how to do that or any other technical questions, Jeff Hand, our IT wizard, is standing by for help. You can reach him at 585-341-4341. That's 341-4341. Now I'll turn it over to Mike. Thanks so much for being with us.
Good day, everyone, and thank you, Jennifer, for that very kind introduction. I am trying to share my screen so we can all, good. I hope everyone can see this. Looking at Jennifer, she's nodding. I think that's a good sign. Thanks, Jennifer. So again, thank you all for attending today in this, as Jennifer said, most difficult, complicated year. Obviously, all of our lives have been affected in very profound ways, and investments have also behaved in a way that was incredibly unusual in some regards and also very typical in others. So I recall we were together earlier in the year when the pandemic was raging, actually almost as badly as today, and the markets were in a very, very precarious state at the time. And we looked at the time, tried to put the losses that were shown in the portfolio in some perspective. And in so doing, we put together this chart. And so what you're looking at here is over the last 20 years, these have been the major declines in the portfolio since that time period. And we define that as a greater than 10% drop in the blended endowment performance. And so the 5 times are listed, with the most recent being the one at the bottom, which we've shaded now in gray. At the time we looked at it back then, we looked at a 20% plus loss, and we didn't really know what that third column, time until high water mark regained, would say. Let me explain what these lines say. So the first line, or the first column, I should say, are the dates of the drawdown. So that refers to the period of time where markets were falling. So for example, you can see the very first line from 2001 to 2002 was a fairly long period of time where markets were heading lower. And eventually the loss at its worst got to be about 18.3%. At that time, the portfolio significantly outperformed the S&P 500. That's the 25.4% return you see there. So it didn't make 25.4%, to be clear. It just outperformed the S&P. So the S&P was down another 25% or so more than the foundation portfolio. It took 14 months to get back to what we call the high water mark. And what that means in English is the high water mark refers to the time it takes you to get back to where you started. There's an old rule in investing, which is quite frustrating and difficult during times like this, which is if you were to lose hypothetically 50% of your money, you have to make 100% in gains to get back to where you started. So regaining a high watermark is a challenging exercise. And it has to, of course, we're relying on it happening. It has always happened historically. Then the last column shows you the performance from the peak out the next 5 years. And the only point we were trying to make here was, at least in the 3 of these 5 times where the markets have fallen precipitously, in each of those times, the portfolio actually, from the peak, i.e. from February of 2001, so pick the worst time possible, out 5 years, actually there were gains. And we were, again, trying to make the point that these very negative periods feel terrible when they're going on. This particular year was worse than any I can think of, probably any hopefully we'll ever see, I would hope. But at the end of the day, returns are generally positive over time. And that's a very significant part, issue which informs the way that this investment strategy and this investment portfolio has been managed for decades. So the good news on this page, which I will tell you I would not have expected to be able to report to you, is at the very bottom. So the loss was quite significant. You can see that the return relative to the S&P 500 was actually negative this time, which was unusual. We'll talk a little bit more about that later. But the point that frankly really surprises me is that 8 months later, we are actually back above the high water mark. So the losses of early this year have all been recovered, and then some. I'll update you on the returns in a minute. Obviously, just so you know, the last column for the 2018 and 2020 period is not filled in, because we don't yet have a 5-year return to report from those periods of time. So I look forward in 2023 and 2025 to hopefully showing you a very strong 5-year return. So we've climbed out of this very deep investment hole we were in earlier this year, one of the deepest you can see in the history of the foundation, but not the deepest. The great financial crisis was worse, and surprisingly quickly. And a lot of that is very much a part of how we think about the world, comes into this kind of behavior. So if we move ahead, I want to share with you the returns of the foundation, basically through the most recent period of November 30th. So the first thing just to highlight for you is we've got 3 lines here. The first are the Community Foundation's blended endowment returns. The second line is a simple 70% stock, 30% bond index that we think is an important way to measure the foundation's performance. You'll see that. I'll come back to that in a minute, the comparison. And then last but not least is the thing we really care about. Jennifer talked earlier about some of the great work that the foundation and all of you have done to support your community during this incredibly difficult time. And the goal of every long-term investor is to be able to do that work, and then also preserve capital on a long-term or perpetual basis to support philanthropy and support the problems of the future, and make the world a better place in Rochester and greater Rochester area. So CPI plus 5 is the way we think about that, and it refers to inflation plus a 5% distribution rate. That's where that calculus comes from. So first thing to point out is let's look at the 2 negative data points, which is the foundation through November 30th. The blended endowment was up 6.1% year to date. So that nearly 20% or 20% plus loss I showed earlier has been erased. Yet you can say, and I will say, that a 70% stock, 30% bond blend would have been a better return. You can see it's up 10.6% year to date. For 5 years, you can see a similar story where the foundation's actually fallen behind that benchmark. And we're going to put this in perspective in a moment. And then you look at the longer periods of time, the foundation has historically earned premiums to those returns. And just to get a little bit ahead of ourselves, I want to mention one thing, which is that the portfolio's underperformance this year is very much related to the things that we're not doing and we won't do. And the reason we don't do certain things, which I will talk about in more detail in a minute, is because we are fearful of only really one thing. We are not afraid to underperform over short periods of time like this. And even 5 years for us isn't particularly lengthy, as long as we stay close. What we're not willing to give up are these long-term premiums because they mean a ton. And if you look at particularly out at the 15 and 20-year periods, the excess performance the foundation's earned over that 70-30 mix was decisive in terms of outperforming the CPI plus 5. And I remind you, this capital doesn't exist to win horse races in the short term. It exists to generate and support and accelerate philanthropy in the long term. So we must have those results you see on the far right-hand side of the page. Now, the last thing I want to add to this equation, if I may quickly, is to look at what's happened since March 31st. And here you see we've kind of turned a lot of things around. So a lot of the things that we wouldn't do in the midst of the pandemic have started to really work. And that's what's ultimately going to happen again. There's a trend in place that we feel very good about. And I'm going to talk a little later about a little more of the detail of what I'm referring to when I say that we like the trend that's in place. And last but not least, I do want to give you one more piece of good news. The portfolio actually through last night is actually now up 9% year to date, and it continues to close the gap with the 70-30 blend. It's actually taken about 1.5% off of that gap you see there. So things are very much heading in the right direction. Now, I want to spend a moment, if I may, on putting short-term versus long-term returns in some perspective. So what you're looking at here are actually the exact same returns as on the prior page with one major difference, which is we're showing you what happens if you compound the returns over time. So back here, when we talk about a 7.9% return per year for 25 years, that's actually a 569% return cumulatively, obviously not per year. And I bring this chart to your attention mainly because you can see that what looks like a relatively modest level of outperformance, even the 15-year column of 7.1 versus 6.6, that translates to basically 20% more return cumulatively. So that's the 180% versus 161% column. So what we like to think about here is while we don't like the 5-year column, the 49 versus the 55, that feels like a very small price to pay if you're going to get 180 versus 160, 570 versus 430. And those returns on the right are what we are very much focused on. And it's unfortunate, but you do need to sometimes make choices. If you want to stay in the horse race very closely all the time, you can't outperform by a lot over the long term. You can't have it both ways. So we choose to subject you, I'm sorry to say, and us as well, and the committee and everyone else, to a little bit of short-term discomfort in exchange for the best long-term outcomes we can achieve. Which leads us to governance and decision-making, which is extremely important part of the way the foundation works. It's an extremely important part of the durability of its success. So the investment committee of the foundation, which meets no less than 4 times a year, is responsible for asset allocation and manager selection. It's an incredibly robust process. It's an incredibly talented investment committee. I can't see whoever, usually when I love to be in the room with all of you, I can see the members of the committee in the room. Can't see you today, but if you're here, I want to just add my gratitude to you for what you do, because it's really quite stunning, especially if you look at those returns that have been generated. Crucial Partners, which is our firm, formerly Colonial Consulting. We are the same firm. We changed our name, just to be clear. We are responsible for advising the investment committee. So I show up quarterly, used to be in person, now via Zoom, and provide the committee with our thoughts, a lot of written material. We work this committee very hard in terms of material to think about and to act upon, and that's our role. We are the independent objective advisor. We do not manage money. We do not do anything that conflicts with what we believe to be the high quality advice we provide. The investment managers are the ones who actually make investment decisions on a stock and bond level. So we don't manage money in the sense of we're not picking between General Motors and Tesla, but we do have firms that have been hired to do that kind of thing and to make those types of choices. Those are the investment managers. The investment committee is at the center of this page for a reason, because they are the critical component of this, and they have us and the managers as their partners and the foundation's partners to make this essentially this whole strategy work. So let's talk about the strategy. And I mentioned the word durable before, and I want to emphasize that Durable is something that we must have. And the second thing we must have is repeatable, which is another way to say the same thing. And strategies that rely on too much brilliance or genius, which we do not possess at Crucial or Colonial, are not going to work over time, if you ask us. They need to be strategies that are based on simple, fundamental principles and advantages that long-term investors, particularly large foundations like the Community Foundation, possess. So here's the basics. One is think long-term. So establish a strategic asset allocation that will achieve long-term objectives. Two, no short-term market forecasts. Now this particular, every year is different. In 2020, avoiding short-term forecasts proved to be extremely wise. I can tell you that if someone had asked me to make a forecast back in April, what actually happened would not have been in my forecast, and something much worse would have been in the forecast. So it's wonderful to know what you don't know, and never, ever, ever subject, in my case, my clients or you, to things that we don't know. Now, what we also do care about a great deal is risk, though. And we cannot afford to have too much risk in a portfolio because there are needs. And today's a perfect example where the needs are excessively large and outsized. So we need to be diversified. We need to be thinking about protecting the portfolio from risk. And in a few minutes, I'm going to get to talking about what we think is the riskiest part of the market today. And diversification will be our salvation when it comes to avoiding any incredibly negative implications related to that. So here's a quick snapshot of what the blended endowment mix looks like. So for many, many years, 23 in fact, it was a combination of 70% stocks and 30% bonds. As we write here in August of 2013, which was actually, we're getting close to plus more than 7 years ago, the foundation looked at fixed income yields and said, the investment committee initially, and then the board, and said, there's no way we can support CPI +5 on a very long-term basis if we have 30% of our portfolio in low yielding bonds. Yields have actually only gotten lower since then, which makes this an even more wise decision. It was an early decision, I will say, but it will prove its merit over time, we're quite sure. So back in August of 2013, the foundation board approved a change, and this is a massive change for the foundation. We don't make these changes often. Keeping the 70% in stocks, we were not giving up on our long-term perspective, lowering the fixed income to 20% and adding alternative investments of 10%. And to date, the alternative investments have added value to the portfolio in absolute terms, but the portfolio is a little less defensive than it used to be. Bonds were quite useful earlier this year, but they're quite costly in the long term, which is why we're very happy with this change that's occurred. So one of the points I made earlier is, for a lot of people today, correctly so, do not want to use active managers. Most of the active management community is not able to add value over time. The foundation's long-term record of adding value really shows that there are certainly exceptions to that. And one of the points that we are very focused on is how do we perpetuate long-term success from the manager lineup we use. And just to be clear, the portfolio uses quite a bit has quite a bit of exposure, to index funds, and it also has quite a bit of exposure to active managers. When you look back at the last 5 years, just to peel back the onion a little bit, the reason that the portfolio has underperformed the last 5 years is not because of active managers per se. It's because we have a value bias in the portfolio, and that has proven to be extremely painful until recently on a relative basis, although it's the source of our optimism looking forward. So manager selection has been quite effective here. I just want to point out a few quick things about that before we turn our attention to the markets and the risks that we're worried about today. First thing, when you're doing due diligence, so the Crucial Partners team consists of 23 investment professionals today. And when they come in the door on day 1, day 50, and day 1000, I hope they're always taught to remember these 4 things. 1, returns are always accompanied by risk. If you want to outperform an index, you're going to have to do something different than that index, and that is a form of risk. The second thing, in the old world, people like me used to travel 250, 300,000 miles a year on a global basis to find the best people we could. And it was keyed in on this idea, which is we must understand the strategy deeply. We must know the key people extremely well, and we must avoid needless complexity. We've obviously been on a hiatus from travel, so like you're doing today, we're learning a lot on Zoom these days from our contacts in the world. We're all very anxious to get back out there, though, and I'm hopeful by maybe the third quarter we'll be back on airplanes again. The third point, where we don't take risk, operational issues. So Crucial has a 4-person operational due diligence team. Their job is to make sure that there are no Bernie Madoff risks in the portfolio and that everything is operationally secure. We take risk from an investment perspective. That's how you generate return. You do not take risk from an operational perspective. That is how that's how you destroy a great portfolio and a great reputation. And the last thing I'll point is this is a forward-looking process. One of the most difficult questions we get today, particularly the last few months, is, you've got this value exposure in your portfolio, it's not working. Why do you keep it? And the answer is because looking ahead, we see a very different outcome than the one we've had the last 3 to 5 years. That sometimes feels very awkward for people, but it's actually the way that investment success is done. The things that make you feel good in your portfolios personally right now are probably the ones that should make you most nervous. And the things that make you feel bad, assuming they're okay things, are the ones you should be most optimistic about. That's not how we're wired as human beings to think, but it's how we should be. So let's talk about the key issues today. First point, balance is essential. There's a real risk in a market like this one where those things you fall in love with become bigger and bigger components of your portfolio, and you don't want to change them because why fix what's not broken? But you can lose balance in that process and end up with less and less of the out of favor areas and more of the in favor areas. And again, that is what unfortunately leads us into very, very big problems over time. The second point, I have never seen anything like this in my career in terms of the opportunities that are being offered by market. It's not just value stocks per se, it's a lot of different areas of the world and within the United States as well. And anyone who has the ability to do rigorous analysis of companies, and in our case, managers, and has patient capital. And patience is mostly about emotion, which is, are we really willing to be patient or not? We can be patient, but what we choose to be is important. We've never seen anything like this. The gap in return that we see on a prospective basis is extraordinary. We can't wait for it to start. I think it may have already begun, and we hope it continues. And the last thing is that, unfortunately, a lot of the more popular interpretation of markets are around stories. Is this company going to do something great? Is that company not going to do something great? And those are really important factors to understand. But investing is multidimensional, and one is the story, and the other is what are you being asked to pay to participate or not participate in that story. And that is something that I want to spend a moment on right now. So the index fund craze, which is, by the way, I will add, extremely well justified. We are not fans of the active management community in general, but there are, I don't know, I haven't done the math, but tens of thousands of active managers out there. And even if 9,000 of them aren't very good, 1,000 are. So there's something to do there. It's just very difficult to know how and when to do that and how to find these people, the ones you want to be with. So index funds have become very popular, and that's great. The problem, though, is that the S&P 500 in particular, which has been the index that I think we would all have loved to have 100% of our assets in, even in this year, has gotten increasingly risky. And the chart you're looking at here reflects the concentration of the top 5 stocks in the index. For those of you who aren't familiar with the way the S&P 500 works, this is the basic idea. There are 500 stocks in the index, hence the name. However, each one has a weight that is associated with the size of the company, and size is the stock price times the number of shares that are in existence. So very big companies like Apple, which we list at the bottom, are a very big part of the index, essentially. So this chart goes back to 1990 and shows you what were the top 5 stocks by weighting. They were all different names at different points in time. Just take the top 5 at every moment in time. How much of the index were they? So if you look at the far right-hand side of the screen, this is through September 30th. The top 5 stocks were 22.1% of the index. The last time they were this high was actually back in the TMT bubble in the late 90s, early 2000s. And even back then, the index wasn't as concentrated as it is today in its top 5 names. So taking a look at the 5, these are the ones. So when you look at that 22.1%, here are the names that are basically in that group of top 5. And what you see here is, of course, all recognizable names, I'm sure, for everybody. Alphabet, if you don't know that name, is Google. And so these names are very popular, and they are popular for a reason. The story is good. These are technology businesses and consumer-facing businesses, and they are incredibly dominant in their industries, and they are increasingly powerful in a time of COVID, especially if you believe that the world is going to be permanently different and altered in some way once we even get past the pandemic. But let's get to that second point, which is, what is the price? So forgive me for those of you who don't like to think about the numbers part of this all the time, but let me just bear with me for a moment. Take a look at the middle column. What that refers to is how much are you being asked to pay for a dollar of earnings? So in the case of Apple, you're being asked at the beginning of this year, you were being asked to pay $22, essentially, I'm doing some rounding, for a dollar of earnings. Fast forward to September 30th, where Apple's done quite well this year, as you might guess. But now you're not being asked to pay $22 for that dollar anymore. Now you're being asked to pay $35 for that dollar. Now let's put this in some perspective. Historically, the stock market as a whole, not the best companies, admittedly, is generally $15 to $16 per share, or per dollar of earnings, I should say. So 35 is a pretty high number. Now, you might say, well, but a higher number is worth it if the company can grow quickly enough. And in the case of Apple, it's mysterious to us where people think the growth is going to come from. The company doesn't really grow that fast anymore. But let's forget Apple for a second. Let's go to the next one down the line. I won't go through them all, I promise. Amazon. Obviously a huge, unfortunate, I don't like the term pandemic winner, it's a terrible phrase, but a company that is essentially, benefited from what's happening in our lives and the fact that we're all sitting in our houses way too much. So at the end of this last year, Amazon was trading at $77 for a dollar of earnings. Now, it makes sense that it would be a high number because look to the right, the company's grown 48% per year over the last 3 years in terms of profits. It justifies a very high price. But that high price has gotten even higher today. It's at $122 for a dollar of earnings. And so you might say, who cares? The company's going to grow. It's going to do great. What's the problem? So let me show you what the problem can be. So let's go back and look at history. And let's take I call them the five darlings from back in March of 2000. So just as a moment here, when we go back, what did I do here? Sorry. Back when the index was 18.2%, the concentration that you see there, these are those names. They were the five at the time. And actually one name, you know them all, I'm sure, but one of the names on this list actually is still on this list. So that's kind of interesting. And we'll talk about that in a minute. And that was Microsoft. But let's focus on the second line, which is Cisco. So it's got an Amazon-like valuation today. It's even higher actually, but 200 times earnings back in March of 2000. And the reason, if you remember, for those, I think most of us are mature enough, I don't say old enough, to recall why Cisco was as popular as it was at the time. And it was a good reason. The story was fantastic, which is that the internet was going to be a really big thing. Cisco was and is a dominant provider of hardware, which we must have to make the internet work. And they were going to be an incredibly successful company with incredibly bright long-term secular growth behind them. All true. Today, fast forward to today, and I think we can clearly agree that while Cisco isn't the only player, they remain an incredibly important part of the internet ecosystem from a hardware perspective and other ways. In fact, they're also beneficiaries today of, unfortunately, what's changing our society, and that they are very much involved with providing wiring for smart cities and all the different, bringing more internet access to rural America and other parts of the country that just need, in the world, that need more access to the internet. So the company's been successful. And take a look at the far right-hand column, and that's a good example of it, which is 10% growth for the last 20 years of earnings. And that's important. It doesn't sound like a huge number, but it's pretty impressive for a large company to grow that quickly. Because for the most part, if the business gets big enough, and we're seeing this today, for example, with a lot of the big tech companies, eventually regulation steps in, eventually competition comes up, and you just can't grow that fast for that long if you're already a gigantic business. But Cisco has defied that maxim. They have grown remarkably quickly. And so what's the problem? So take a look at one more thing. The S&P 500 has risen 123% from March of 2000 to September of 29. So you remember 29 of this year, excuse me. So you remember earlier I showed you the growth of the foundation's portfolio cumulatively. This is the same basic analysis. So now here's the punchline, which is take a look at these stock price performances. So let's focus in again on Cisco. Cisco has been a massive success. The problem is at 200 times earnings, there was too much optimism in the price. And now the performance of Cisco over this 20-year period, I'm not sure why we put September 29th, September 30th didn't change, just to be clear, has basically dropped 50%. So a dollar that you invested back in March of 2000 in this great internet company is now worth basically 50 cents. And that's not in inflation adjusted terms, you just lost half your money. And when you get back to CPI plus 5, we can't have much, if anything, in investments that over 20 years drop in price. We need to make money. That's an incredibly important thing and generate positive returns. And so this is where you get a sense of why it's a two-dimensional equation. But let's fast forward to one more quick point here. What about Microsoft? Microsoft has stayed in the top 5 for 20 years, although I will remind you and point you out in a second, that's not actually been exactly right, but it was back in March 2000 and it is again today. It was trading at a very high valuation in March of 2000, and the company's grown, kind of to a similar degree to Cisco, so very successful, and the stock price is up 290%. So, Mike, why can't the 5 of today be the exact same story? And the answer is they could, but it's very unlikely. And let's just peel back the onion one more layer on Microsoft. So this graph shows you the performance of Microsoft. It's the blue line on the graph compared to the S&P 500, which is the red line on the graph, cumulatively since March of 2000. So again, these are those cumulative returns. And what we're looking at here is anytime the blue line is below the red line, that means that Microsoft is underperforming the S&P 500. And because of the way the graph kind of looks, and it's very kind of top heavy in terms of the big numbers on the right, basically what you're looking at here is 30, 40, 50% levels of underperformance compared to the S&P. And in fact, if you have a real eagle eye, you can see that actually Microsoft had a negative return, pretty much negative absolute return like Cisco did, from March 2000 all the way on a cumulative basis till about 2017. And actually it didn't outtake or outpace the S&P until 2018. So I would say this to you, anyone who paid 66 times earnings from Microsoft, or $66 for $1 of earnings, was not envisioning that they'd have to wait 18 years to finally see something good happen to that investment when they could have been in the S&P 500 the whole time and done much, much better. And the only reason Microsoft did recover is new CEO came in 5 years or so ago, completely refreshed their business model. It was essentially a different company at that point, almost like a new one. And even though it was not the same, it was the same, of course. But the reality is that this is not a good outcome. And Microsoft just happens to have that return, but it all happened in the last 2 of 20 years. Not a good outcome. So the foundation portfolio we own Microsoft, we own Apple, we own a lot of those names because we have index funds, but we're very careful about how much we own in them because the outcomes don't look good on a long-term basis. And it's not about these companies. It's about the fact that stock prices are very, very high in some cases, but not all, of course. But consistency is the key to what we do and how we think about the world. Volatility and uncertainty are things that we embrace. And so some of the performance recovery that you've seen since March was really the product of simply an incredibly calm, talented investment committee, not panicking, maintaining its strategy, as Jennifer referred to earlier, and capitalizing on the fact that in a very, very difficult time, markets are more likely than not to misprice assets. And what we've seen this year, and the Apple, Amazon comments I've been making during this conversation are very much around the idea that people are getting way too optimistic about the long-term prospects of very large technology and consumer-facing companies, and they're way too pessimistic about more boring businesses, banks, God forbid, travel businesses, things that are, frankly will survive. We will travel again, and the stock prices are incredibly low. So all of these things create opportunities for the foundation, and it's very important that we capitalize on them. And that's the last point, which is we have a very, very diversified asset mix, some incredible investors who are making decisions on a day-to-day basis about which stocks and which bonds to own. And that's what's led to this last graph, which is, this is again what we must have. We must have, I showed you earlier, performance above CPI plus 5. We're going to get there by beating our indexes over time, like we've done for 10 years, 15 years, 25 years, and in the last 8 months, as you can see. The periods in the middle that we don't like so much, we're willing to pay that price in order to get the outcomes on the right. And the way that's done, again, is discipline, consistency, and a strategy that is very much built around taking the other side of what's popular in markets at any moment in time. So I thank you for your attention, and I'm going to stop sharing my screen now.
Thanks, Mike.
And welcome, Andrew, by the way. Welcome, Andrew.
You.
Sorry.
Well, and again, thank you everyone for joining us today. I'm Andrew Muldoon from the Philanthropic Engagement Department at the Community Foundation, and we're grateful to be able to engage with you, albeit through Zoom. Mike, thanks for sharing your expertise. And we have a few questions that have come in. So if, as a reminder for everybody that's joining us, if you look at the bottom of your Zoom screen, you'll see a Q&A box. You can click on that and then add a question, and we'll do our best to get to them this morning. If something should come to you after this presentation is over, you can email them to me or somebody on the philanthropic engagement team whom you work with, and we'll get them off to Mike, and he promised to do his best to get them back to us a good response pretty quickly. So Mike, are you ready to jump into this?
All set.
All right, great. So we have a couple questions around alternative investments. So if you wouldn't mind defining them and then actually sharing a little bit about what actually goes into the alternative investment bucket. It seems a little opaque the way we talk about it. So the more detail, the better, if you don't mind.
Perfect. I'll try not to give
Thanks.
you too much detail because we can take up the rest of our time on a very large topic. But the relatively short version is this. So you're right. That's a bucket that means nothing when you use that phrase. So let me define it as Andrew's suggestion. So currently, what the foundation's done in that category is essentially added hedge funds to the portfolio. The vast majority of them are what we call long short equity hedge funds because we like the fact that they're liquid. They are very easily understood. These are managers that own stocks like other managers in the portfolio, but they also short sell stocks, which is how you can profit from falling stock prices. And so that's essentially what the portfolio is in right now. It's been an effective part of the portfolio. It is riskier than the bond market, but less risky than the stock market. And the second thing I would point out is the committee, though, is in the process right now of considering whether or not to expand that definition to include private equity and other areas. We're nowhere near actually allocating capital in any of those types of places, but the committee is constantly challenging itself and me and the rest of the team to ensure that we're doing the best things possible. So right now, it's literally all hedge funds and equity hedge funds, but it's been a very, very, very positive part of the portfolio.
Thank you. A question about the equity allocation. Do you mind sharing what the percentage is between domestic and foreign?
Yes. So the percentage today, well, I really should, let me just bring this up. I'm not sharing my screen, and I just want to be able to answer that question very specifically. So today the percentage is, forgive me for just looking at this, I wasn't ready to answer that for some reason. Today the percentage is 55% of the equities are domestic and 45% are non-US. So it's a 55%, 45% weighting. And it's been there, by the way, for quite some time.
Thank you. All right, so I'm going to read this question verbatim for you. All right, so with the S&P 500 selling at about 27 times 2019 peak earnings and earnings now down substantially, how can we feel any sense of positive expectations for stock market returns for the next few years?
My favorite question. Did I type that one in for myself? That's an amazing question. I love it. So here's the thing. The S&P 500 is not the stock market. So all those statistics you quoted were spot on. And I'll give you a number that we think about, which is we don't really know short term, but we do think a lot about longer term returns. And so I by the way, 3 years doesn't feel like short term to most of us, but for us it does. So when we look at a decade, and we look at the S&P 500 and we look at its valuations, and we love to use something called a Shiller ratio, which takes 10 years of earnings, inflation adjusts them, and calculates. I showed you that 20 times or 100 times PE ratios before. Shiller ratios are another way to do the same thing, but the E piece changes. So when we do that work, what we come to, and this is why you shouldn't be optimistic if you own the S&P 500, we come down to maybe a 4% return per decade from the S&P 500 going forward. So 3 years, who knows? 1 year, who knows? But 10 years, unfortunately, the odds are not good of getting much better than that return. You can get a little better, of course. Now, the reason that we don't say the S&P is the stock market, though, is when we run the same kind of math for cyclical businesses, non-US businesses, all the things that we have more of than the S&P, then the returns go up quite a bit. Now we're looking at 8-9% returns per year because the valuations are not that high. And we think we own good businesses, by the way. And the second thing is, if you get into the really, really interesting parts where you're picking, let's say 10 or 15 or 20 stocks that are good companies that are really inexpensive, it's pretty easy to get to a 15 to 20% expected return today from those stocks. So that's why we don't agree that the S&P is the stock market. If in your portfolio, the S&P is the stock market, then I would be thinking long and hard about how you might make some adjustments, not to completely run from the S&P, because who knows, but maybe to diversify that just like the foundation has done.
Thank you. All right. Mike, I have 3 more questions and we'll see if any others come in. One is, how has the current low interest rate environment changed the risk reward balance for the foundation's bond holdings?
It's created a lot of issues. By the way, I've been around a long time, as Jennifer pointed out in my bio. And in the old days, it was easy, easy because it didn't feel that way at the time, but you put 60% of your portfolio or 70% in the foundation's case in stocks, you put 30% in bonds, and life was good because you thought your bond portfolio could generate a 3 or 4% return over time, maybe even a little bit more. But unfortunately, low rates, as that question suggests, have complicated that a lot. So one thing I mentioned earlier is the foundation has lowered its bond exposure. It was done about 8 years ago, 8 years ago. So that's one reaction to it. The second, and this is more on point to the question, I'm sure, is within the bond strategy, we've done a lot of things that I think are really important. One of which is to add non-dollar bonds to the equation. So we're looking to essentially diversify away from pure interest rate risk. When rates are low, unfortunately, as I think the question implies, you do have a bit of an issue, which is that rates can drop only so much from here, and that's where you might get gains. So for those of you who don't think about bonds all day, when interest rates fall, you get price increases. When interest rates rise, which happens during better economic times and during times of inflation, you get price losses. And so bonds, when you look at the bond market in the United States today, the yield's about 1.2% on what we call the Bloomberg, or the used to be called the Lehman/Barclays aggregate. So 1.2% arguably is your best case scenario if rates don't go anywhere and just collect your coupon. If rates were to rise hypothetically by 2 percentage points, so let's go to 3.2%, and let's say that happened, again, hypothetically, it wouldn't happen this way, it happened overnight, you'd essentially have about a 7% to 8% loss overnight on your bond portfolio. And so that's why the risk reward is very skewed. So we do own some US bonds, the things that are subject to the forces I just described, but then we've diversified away from them with some non-dollar bonds, some below investment grade bonds, and some short-term bonds. And that's how we control for this risk. Now you might say, but why? Why even hold the 20% in bonds? I'll just ask my own question. I'm running out of time, but I'm going to ask it anyway. The reason is because every now and then stuff like March of 2020 comes along and rates fall, and bonds serve as an incredibly important ballast to an equity portfolio that's 70% in stocks. And so that's why we own bonds, but we're very, very cognizant of the fact that these are not going to contribute to CPI +5 on a long-term basis. So thanks for that great question as well.
All right, Mike, here's a two-parter, but I'm going to frame it with the changes that the foundation made in 2013 with our investment strategy. Is there any particular market situation which would cause you to consider adjusting to the prevailing investment strategy or policy? And thinking about those determinants back in 2013, which moved us to the 70-20-10.
I'm not sure I fully follow the question. So is it what would cause us to change the 70-20-10? Is that the basis of the question?
Yeah, is there anything going on, any prevailing investment strategy or policies that we're thinking about to take into account the market that we're in now?
My apologies. No, we actually are not thinking of, so there's nothing happening at the moment that's causing us to want to change the current structure. And there's two reasons for that. One is that even though the markets have obviously changed a lot since 2013, as long as we can find opportunities, again, back to my earlier answer to the S&P question, since we have this very broad global way to look at things, the portfolio can be tilted to areas of opportunity within a larger opportunity set. So 70% stocks, I can't imagine a scenario where that won't be somewhat sacrosanct, because that's what drives the returns over time. And if we can tilt our portfolio, whether it be in the US, out of the US, towards cyclical businesses, towards growth businesses, whatever's in and out of favor at a moment, there will be opportunities there. Then the 10% in hedge funds is important because that's a step towards diversification. And one thing the foundation is very much on a journey towards is making sure that we have as much diversification in a prudent way as we can. So we're not likely to go backwards in that regard. And of course, there's the 20% bonds, as that other question a minute ago suggested, which are complicated for us today and problematic. But we're not likely to go lower than 20 ever, because again, we'd be giving up a very important part of the balancing act that we have to keep. But if rates were to rise a lot, just to get that equation on the table, that would create a very interesting problem for us, which is now bond returns would look a lot more competitive than they have in a long time. Our first step would be to adjust inside that bond portfolio to capitalize on that. But if that happened at a time where the stock market somehow globally was less interesting, or alternatives were less interesting, we might make a shift in that regard. But there's nothing in the works right now to change things. And again, it took a long time to change that 70-30 to 70-20-10. It will take an equally long time, I would imagine, for it to change again.
Thanks.
I hope that was responsive to the question.
I think so. Mike, can you share your perspective on cryptocurrencies as a possible allocation in the future?
Yeah, wow, that's an interesting one. So cryptocurrencies are a fascinating area. So I would never say never, i.e. that I would never say we would never own something that had a connection to cryptocurrencies of some kind. But at the moment, there's nothing envisioned. And one of the challenges with things like cryptocurrencies, for us at least, it's kind of similar to commodities and gold in one regard, which is that they obviously have a place. And you can argue in a diversified portfolio, there's room for something that, basically in the case of cryptocurrencies is a alternative to fiat currency, and especially in a time of great money printing around the world and modern monetary theory. I get why people are interested in this topic. The challenge we have, though, is that what's its expected return? So I love to be able to say to you, hey, we're paying 8 times earnings for something, we're getting a 6% yield, and we're paying less than book value for the stock portfolio. Unfortunately, cryptocurrencies are a little bit like gold in the sense that there's no real fundamental value for them because they don't generate cash flows. They're just a thing. And so that makes it tricky for us because it is, what did crypto hit 2,000 today? So if Bitcoin's 2,000, is it worth 2,000? Is it worth 4,000? Is it worth 200? And the answer is who the heck knows? And so that's a frustrating thing for us. And so until somebody figures out a way to value them, which I doubt will ever happen, we're never going to own much, if any, I would say, just like we don't really own gold either, by the way. We might own gold miners in theory, not that we do, if the price of a company was really cheap compared to the commodity. But again, until we can find a Bitcoin company that we can play an arbitrage against the value of Bitcoin, I don't think we're going to be doing much of that. But again, it's not because it's a bad idea and has a role, but it's hard for us to wrap our heads around it as long-term, valuation-driven investors.
All right, great. A question about China, whose production has grown by about 7% compared to our production, which grew at 0.7%. What's your view on opportunities there?
Yeah, wow, complicated question for sure, and one that's dominating a lot of our time. In fact, we have a daily team call at Crucial that started in the pandemic. We didn't used to talk every day, but now it's one of the only, I'm sure in most of our lives we found some small snippets of things that are good about the pandemic, not the pandemic, but the fact that we're not together. China is an incredibly interesting topic. So we have spent the better part of 5 years visiting China, finding investments there, looking at investments there, and struggling with this question, which is what do you do about one of the biggest economies in the world, one that's growing incredibly rapidly in an incredibly rapidly growing part of the world, with at the same time where the protections for investors are not nearly as good, where you do not have a democracy, you do not have a government that can be trusted to act in the interest, particularly of foreign investors. And so it's a really challenging problem. Fortunately, we found investments over there and investors, and the foundation employs one manager in its alternative sector that does some of its investing in China, but is based in Hong Kong. So it's an area that will continue to be of interest to us and continue to be important. But I want to assure everybody that we don't like to pass up on opportunities, and there are opportunities in China to invest both publicly and privately today, I would say. But at the same time, proceed with great caution. You have to be incredibly careful about investing in a place that you don't live in, and particularly one which has a system that's much, much different than ours.
Thanks, Mike. Do you project hyperinflation as a result of the new administration and COVID-related spending?
Hyperinflation? No, we don't. I mean, we don't make economic forecasts, to be clear. Inflation, though, should rise. I don't know how much it would have to do with the administration per se. I think it has more to do with a couple of other things. So one is the second part of that question I think is important, which is there's a lot of liquidity in the system. And our Federal Reserve and I think other central banks around the world have been pretty clear that they are willing to tolerate some inflation here. And the main reason for that's logical too, because they've been unable to get economies moving around the world, except for China and parts of Asia for the most part. And so they're willing to err on the side of too much inflation at this point. So inflation should be a force that grows. And a related point to that I will add, if you don't mind, is that not just the pandemic, but even before the pandemic, increasing trade tensions, increasing nationalism around the world, all create a situation where there's a lot less trust around the world than there was, let's say, 10 years ago or 8 years ago. And so the fact is that if you're a manufacturing business anywhere in the world, you're looking to maybe bring most of your manufacturing or some of your manufacturing back on shore, particularly critical parts of your product process. So that's, by the way, that could be extremely good news for labor in America. So let's hope that happens. But it could also be inflationary. All this stuff moved offshore because it was cheaper. So if we bring it back, it gets a little more expensive. That's inflationary. But if you think about, take that to its logical extreme, if we actually end up with an economy that creates more jobs and more high-paying jobs for people of a variety of different walks of life, we might get some inflation, but we also might get a really great economic boom at the same time. So, there's a lot that could happen here that could be really, really positive. I'm a glasses half full kind of person, so hopefully I'm not missing something important on the negative side. But the reality is that inflation should be part of our future, which, by the way, gets back to the reason that low interest rates should be somewhat disconcerting to people, because if we do get real inflation, interest rates almost have to rise when that happens. And that would be, by the way, last thing, if you're a value investor, hallelujah. One of the greatest things that will happen to value investors will be the rise of interest rates. Not too much, of course, but that's another thing we think about too.
Thanks. So thinking about ethical investing, can you share a little bit about where our managers fall within that and our perspective in that space?
Yes, so this is sometimes referred to as ESG investing, environmental, social, governance investing, ethical investing, values aligned investing. There's a lot of terminology that's used today, and it's a very big focus for every foundation that we work with, and I know at the Community Foundation as well. So what we think about in that regard is we want to make sure, and the question was really well phrased, we want to make sure that our managers are focused on the risks of ignoring these issues. That's the key thing. So in ignoring environmental issues, ignoring social issues, ignoring bad governance in a company is not a good strategy. It's a basic risk assessment tool. So one of the things that we're doing at Crucial, and we'll begin to share with the committee more and more, is assessing the degree to which managers are thinking seriously about these topics. Mainly because we just don't want to end up with anything in the portfolio where it looks good, and then suddenly, they do something that damages their business because they aren't really well behaved as it comes to corporate citizens or citizens in general. And so that's just a part of the equation. And we would expect managers who are, investigating a business's future prospects, the quality of their management team, they should be asking questions about, are you polluting things, or what kind of risks are we taking as an investor when we invest with you? I want to be clear. When you think about the risks of ESG structure or problems or issues, it doesn't necessarily mean you don't own companies that are challenged in some way, shape, or form. The foundation doesn't have exposure in any large degree to that. But the reality is that it's just about the price again. So you could buy a business that maybe is cleaning itself up, by the way, which would be wonderful, but the price reflects the risks, and you can make a lot of money when that occurs. What you don't want to do is own a business where there's a lot of risks and it's not in the price, and they're in the price, excuse me, they're not in the price, and you could lose a lot of money because those risks come to bear. So again, it's two-dimensional, but deeply thinking and asking the investors who manage the foundation's assets to really focus on these issues is essential. And I will tell you, last thing, I don't know too many people today who, in our world, who aren't thinking about this. It's not a fringe idea, if it ever was. It's a very mainstream idea because it's about risk and it's about what you're being asked to take on as a shareholder.
Thanks, Mike. A question from one of our organizational partners who mentions that we in the past have shared a benchmark, the Investor Metrics E&F universe,
Yes.
where we had performed well against the benchmark. Is there anything you can share about this, and or is this something that is publicly available, or is it proprietary? And is it something we can share?
Investmetrics data is proprietary. We have shared in the past. I didn't share it this time, not because I didn't want to show it to you. It's not done on a monthly basis, it's done quarterly, so we don't have November figures. But what we can do, and if anyone would like on the follow-up, I'm happy to, for the year-end figures to put together the chart like we've done in the past. So I apologize for leaving it out this time. That was not an error. That was an error of omission. But I'll give you the punchline as we see it right now. It looks to us like the foundation is going to end up this year somewhere in the second quartile will be our guess. The year's not over, so who's to say for sure. Those 5-year numbers that you saw, the underperformance, that'll probably push the number a little bit below the median. But when you get out to those long-term numbers, again, the 10, the 15, the 20 years, the foundation is going to have the top record that you've seen in the past. So it will be, I think, a fairly similar view to what you got of the performance chart I showed you in the beginning. But I'm happy to share that data we are allowed to do that. We're a customer of theirs, and I can get you that.
Thanks, Mike.
My pleasure.
Thinking about our fixed income portfolio, do leveraged loans play a part in that?
Yes, we have a small exposure to leveraged loans. We've wrapped it into what I referred to below investment grade credit as a small part of the portfolio. So that part of the portfolio includes leveraged loans and high yield bonds. So those are all below investment grade issuers. And we're very happy to have some exposure. We're careful about how much, because leveraged loans, high yield bonds, anything with a lower credit rating is going to naturally be more susceptible to difficult economic times. And that happens at the same time the stock market's having problems. So we don't want to have our bond portfolio have too much overlap with our stock portfolio. That's a critical thing, especially at 20% in bonds. But we do own some, and that's how we're doing the balancing act that the earlier question around, what are you going to do about the rate risk problem in the bond portfolio? Leveraged loans are part of that solution for sure. Again, with a modest allocation, because we really can't have our 20% bond piece acting like a stock market in a bad quarter or a bad month.
Mike, what about real estate in our portfolio?
Yeah, we have some public real estate, public REITs, I should say, which own real estate as they back the assets ultimately. But the foundation and this exploration of private equity I mentioned earlier, I probably used the wrong term. I should have said private assets, because that would include real estate as something that the committee's already begun to talk about a little bit. Real estate is a fascinating asset class, and it's one that has a lot of really positive characteristics for an endowment investor. The problem is that it's been a very expensive asset class for quite some time. But that's changing, sadly. And real estate is a very complex place, particularly commercial real estate today. So we are, as some of the comments I made earlier, we're naturally attracted to complexity and difficult times, not because we want people to suffer. We do not, just to be clear. But we're not responsible for that part. But if there are opportunities to own really good real estate at really good prices, Foundation's always interested in that. So that's some of the things that we've started to talk about. But it's very, very early on, just to be clear.
Thanks. All right, so I have two more questions, and then we will gather questions and do a follow-up by email, and perhaps we can save that response for when we have the that graph available to us. So thinking about things now and the pandemic world that we're in, do you see ETFs in U.S. infrastructure as a good investment with the incoming administration?
I think infrastructure is interesting, and the incoming administration may or may not actually, produce large amounts of spending in that area. So yeah, there's something to be said for that. The issue, ETFs are a great way to get a general exposure. If you're able to do the company work and figure out who's going to be kind of really nicely positioned individually, that might work. And the ETF can do the same thing if the companies that are going to win are going to be the bigger ones, because they'll be a bigger part of the ETF. So that all makes some sense. I'm wary of generalizations though, and it may or may not work. I will tell you, this is not in the Community Foundation's portfolio currently, but we've been very focused on digital infrastructure. And I mentioned earlier, I alluded to, let's get rural America wired up more. Let's have cities that are better wired. The pandemic, as Jennifer said earlier, has exposed some of the fissures in our society and around how people's lives are being impacted. And technology clearly has proven to be a significant area there. So you could see the new administration and the Congress, regardless of whose hands it ends up in, basically being very focused on how do we make the playing field more level for Americans. And so digital infrastructure, if you can find something like that, is interesting. This is where private assets can be fascinating. There are funds out there, particularly one that we like, that's connected to Cisco of all companies, as I've beat them up before, that's doing a lot of digital infrastructure. So yeah, it's a really, really interesting area. And I like the thought process behind the question, just to be clear.
Great, thanks. And we're going to wrap up with a question back to the S&P 500. So if we should be diversifying away from there, where do you go? Do you think international? Do you think, what are your thoughts around that?
So let me put some perspective on the answer, and then I'll give it to you. So first, when I say you should be diversifying away from it, I mean that. But I want to be clear. How do I say this in a nice way? A year from now, there's a fairly good chance that if I see whoever asked that question, and if they take my answer to heart, they'll come up to me, hopefully in person at a wonderful place in Rochester, and say to me, that advice you gave me last year was wrong because the S&P was better. And I think that's actually probable, just to be clear. But 10 years from now, if we can meet at a nice place in Rochester and discuss what was better, I'm pretty sure what I'm about to say is going to be right, which is this. What you can do is you can diversify in two ways. One would be to diversify outside the United States. I think that's a very smart thing to do within reason. And you can do it with developed markets like Europe or Japan. You can do it with diversified emerging markets indexes. That gets back to China a little bit. China's become a very big part of those indexes, so be careful. The other thing you can do within the United States is tilt your portfolio towards value indexes a little bit more. And again, we're not talking about sudden movements. If you were 100% in the S&P 500 today, we're not saying, oh, put it all in value indexes. We're saying gradual, slow movement, 10% maybe goes into value indexes, maybe another 20% goes into non-US indexes. Then you sit there and you watch it for a while. I mean, slow moving is always a good idea because we have no insights into what will happen short term. And so don't have confidence that anybody knows what will happen next, because we don't. We just have a good sense of what 10 years will look like.
Thank you.
Hopefully that answered the question a little bit. And again, I'll buy you a drink, whoever that was, if we're wrong in 10 years.
Well, you brought up a great point. We are so grateful that we were able to bring everyone together here on Zoom. But boy, we look forward to a time where we're together again in the same room, sharing a drink, hopefully celebrating great outcomes within our portfolio and our investment strategy, and celebrating with the great philanthropists of Rochester who have chosen to partner with the Community Foundation. So Mike, thank you for being here today. And we really appreciate all of your guidance and support and leadership. And we're grateful that the investment committee is here to support all we're doing. Jennifer, not to put you on the spot, but thank you for all you do. And if you'd like to send us off, that would be great. Oh, I'm sorry, Jennifer. I put you on the spot and you were muted.
I am muted. I can do it again. Happy holidays, everybody. I'm so glad that together we have built a powerful tool for community philanthropy, and that Mike has helped us continue to grow it through the years, despite the ups and downs of the markets. And thank you for pushing us and supporting us and being part of this movement for community change and betterment.
Great, thank you. So please, if there are any other questions, you can reach out to me. We have on the screen my email address, amuldoon@racf.org. We'll make sure they're all routed to Mike and that we get back to you as quickly as we can. We look forward to this being an ongoing discussion and hopefully seeing you in person again soon. Thank you very, very much.
Hi, everyone.